You might remember this phrase here, which is that a partnership is a general or a common law relationship that is created when two or more persons carry on a business in common with a view to a profit. If those things happen, a partnership exists. That doesn't require any system of registration. So, what does that mean? It means that sometimes a partnership can be found by the courts retrospectively, where one and sometimes all of the parties, the persons in this particular relationship, don't want it to be deemed to be a partnership. And again, at the very end, we'll talk about joint ventures. And look, that can be quite an important consideration because companies, for example, companies don't exist unless you've registered it. If you're not registered, if it's not literally stored with ASIC on the company registrar saying that it's currently registered, you don't have a company. It's a product of statute. Whereas partnerships and trusts, which we'll talk about next week, are products of the general law. And that means that if these factual circumstances exist and somebody can go to court to demonstrate that, partnership would have been deemed to be in existence when this thing happens. Now, partnerships, for the purposes of the partnership law, can sort of come up in two ways. You can either have a partnership that arises without a formal agreement, but usually, and 99 times out of 100, you'll have some form of formal agreement that involves an instrument. We call that instrument the partnership agreement, usually where you go in that and you can map out a whole bunch of things. Now, there is a statute. It's quite old, 1890s. So it's a softly approach. What does that mean? It means that these common law rules about partnership, this judge-made law, isn't really displaced much. Occasionally it is. Occasionally there are certain points where they've said you've got X, Y, and Z, but generally they've taken what judges have said, or said a long time ago. I mean, it's 1891, so it's quite an old act, and have just said, yeah, okay, what judges have said here at this particular point, yep, we'll go with that. And so this definition, for example, two or more persons carrying on business in common with view to a profit, that is the definition in the common law, and that's been followed and expressed in the statute as well. When it says person, does that include or exclude companies?
It would include.
Class does include. How do we know that it includes it?
Because
I'll put it up on
the
the
company
screen.
is artificial person.
It is. Yep. Why?
That's a statute.
Yes. Yeah. It is. There's a very particular statute. Can you remember what it was?
Not quite well. I'm sorry.
Can't remember this one here. It's this guy. Capital D. This is the Queensland one. This is the Queensland Act Interpretation Act 1954. And it just says in an act, in any piece of legislation, Queensland legislation, reference to a person generally includes a reference to a corporation as well as an individual. And there's the equivalent, it's section 2 capital C in the federal statute as well. And so that means when we're looking at the Partnership Act, it is including companies as well. So you can have multiple companies, multiple people, or any combination thereof of legal persons in a partnership. Okay, what else do we need to know about partnerships? Look, you don't need a formal instrument or agreement. You can have just through demonstrated, just by having a business and carrying on a business in common with a view to share profits. Usually you do have some form of agreement. Again, it doesn't have to be in an instrument, but you almost always do, because when you've got a partnership agreement, it's contract. And so you can use the rules of contract interpretation to interpret it, and there's no ambiguity about what's written down, at least. Okay, so there's a couple of real important rules about partnerships in the general law and in the governing statute, which is the Partnership Act. And you may or may not be aware that partners are liable for all of the wrongful acts and contracts that other partners undertake or do within the scope of the business. So if there's a business and you're operating and one of your partners does something stupid, signs a stupid contract, cuts a bad deal, you are going to suffer as a result. If one of your partners is negligent, you will suffer as well, because the way that partnership law is set up, it makes each other person jointly and severally liable for the debts of each partner. And there's no mechanism for limiting this liability, at least in the general law. If one partner loses millions of dollars, all of the other partners have to cough up. It is unlimited liability. So if you're in a partnership and it goes very badly and a very large amount of money is owed to creditors, you are going to be held liable. You'll lose your house or whatever you have as part of that. Nothing to note just about partnership generally is that, and by default in the general law, where a person joins or leaves or dies, partnership is dissolved at that point. All right, these are the general rules of partnerships themselves. Another important thing to note about partnerships, and this is a pretty big one, they're not legal entities. You don't sue a partnership, you sue individual partners. And look, you could sue literally all of the listed partners, but you're suing individuals. You're not suing the partners themselves. Have any of you guys set up partnerships or been in business partnerships with anyone at any stage?
My dad was a partner.
Oh, really? Okay. In a professional setting?
Yep.
In a business?
Yep. He had this contracts and all. Yep.
Okay. Yeah, that's a I've had a few of these over the years. My first one was when I was 22, actually. And me and I remember this because I was 22, my friend was 18, and we had a business building and selling computers. This is in the turn of the century. I remember this also because we had our partnership, and I think over the course of that tax year, we either made or lost $8. I think we make it worse. I actually think we might have made $8 because then we didn't file on time, so we had to pay a penalty. We had to pay a penalty of $50 or something each for not filing on time, which was a little bit sad. Whereas if we'd lost, if we'd just spent another $5, we would have been fine. $5, $6, $10, $5 each. So that you in Australia, where you've got a partnership, you technically don't need to have an ABN and a TFN. That's an Australian business number or a tax file number, but you could be crazy not to. Because partnerships actually have to lodge tax returns. Okay, and so if you've gone and you've actively, willingly set up a partnership, go and get a tax file number because you'll have to do a separate tax return for the partnership itself. Because even though it's not a legal entity, it is a taxation entity. So for the purposes of tax law, it's considered to be its own entity. And certainly for you guys doing accounting majors, it's an accounting entity as well. You can create a set of accounts for a partnership. It's a kind of a trivial thing to do, really. You will still use all of the same rules for valuing assets, for determining provisions, for determining contingent liabilities, and so on. You would still use all of the same rules for doing that. Oh yeah, Akil, yep.
Simon, does this mean that the partners and the partnership both have to pay taxes?
Yes. Well, yes, no, / no. We'll get to it, but you have to do a partnership return, but all of the income for a year for a partnership must be distributed to the individuals or companies that make up the partners of that particular firm. Sometimes I use the term firm to describe a partnership. The idea is that the partnership itself does not pay tax, nor is it liable to pay tax. It must distribute all income and all losses to the partners. It's slightly different from trusts, which we'll do next week, where trusts can withhold income. Admittedly, they don't usually because it's taxed at a high rate, but they can. Partnerships can't. Partnership must distribute all of the income in a given tax year to the various partners. Again, based on rules usually which are mapped out in the partnership agreement, but we'll talk about that in a bit. Okay, now a little bit of a fib, not really. The partnerships I'm talking about, this are general partnerships. And the reason why I'm talking about that is that these other types where you could be limited by guarantee or incorporated and actually have legal personality, the reason why I don't talk about these ones here, other than one slide towards the end, is that these ones, the bottom two, are actually taxed like companies. So they don't really use all of these rules of partnerships. It says that it's a partnership, and you found over the last 30 years that the various professions have tried to push back at originally they had to be in partnerships. So law firms, accounting firms, and so on. They've sort of pushed back. Parliaments have all over the world have sort of been pretty slow, but eventually have got there in terms of letting them have limited liability. And so as a result, when you've got entities that are either limited partnerships or these incorporated limited partnerships, they're actually taxed like companies. So they sort of fall outside the scope of what we're talking about today. So here, we're only talking about what in the general law and in the statutes, the governing statutes, are called general partnerships, where you've got unlimited liability for partners for all debts and all obligations that may occur. And they've got equal responsibility as part of those. Now, for those that are watching this recording and may have attended the lecture or watching this later, I've added this slide for whatever reason. I forgot to talk about the idea of a fiduciary duty. It's a really important phenomenon in that fiduciary duties are a very high bar. We think about duties and the different types of duties, and those that studied with me last year or previous years study the business law subject, actually these days I teach the undergrad as well, but certainly the postgrad. The concept of the fiduciary is to place a very strong burden on one person, usually the strong party in a relationship, so that they, and the law makes them, look after the interests of the weaker party. And so, examples of fiduciary duties or established categories of fiduciaries are trustees and beneficiaries. You've got directors in regards to the company. You've got employees in regards to their employer. The idea employees aren't supposed to go and misuse their position to make a profit as well. And you have these what are called status-based fiduciary relationships. Partner to partner is a status-based fiduciary. It's curious because neither side is weak or strong, so to speak, because they're all partners in the firm. However, because they all have this strong ability to really hurt each other, the law deems them to be fiduciaries. They are not allowed to make secret profits. They are not allowed to take bribes. They are not allowed to do things that undermine the relationship of trust and confidence that partners have between each other. That relationship is held to a very high standard. It's known as a fiduciary obligation. And a couple of things about fiduciaries. One is that you can't contract out of them. And this kind of makes a little bit of sense. For example, if you are an employee, you can't sublet your work, for example. If you're an employee working at McDonald's, you can't go and get someone else to come in, step in your shoes, and you get paid the money and they just do the work and then you pay them or whatever. Get your little sister to go jump in and work for you. You can't do that. Similarly with trustees and trusts, you can't get someone else to be the trustee. Company directors can't delegate. You are the director or you are not. And partners are in this situation. They can't delegate that or assign their obligations to third parties. You can't do it through contract. You can't do it the general law. And that's broadly what fiduciaries are about. And note that the remedies you get, they're remedies in equity. So a couple of things come from this. One is that you can use the various flexible equitable remedies. So if somebody breaches their fiduciary duty as a partner and goes and makes a secret profit, you can get what's called an account of profits. That means if they go take that money and buy a lotto ticket, I kid you not, this is the way the law works, and that lotto ticket wins, you can actually ask for the proceeds of that lotto ticket, even though the amount that was stolen might be really small, that you stole from your partner, for example, business partner. And this is to do with policy reasons. We don't want people breaching fiduciary duties, so we place outrageously high levels of obligation on them. And note that these remedies, and I've got this down here with the Yu Yang case. So it's always funny when I say this, but there's no common sense. There's no common sense in law generally, but sometimes you'll have tests of causation that have some aspect of common sense. Well, breach of fiduciary duty does not have that component. And so the purpose of compensation, or sorry, the purpose of getting remedies for these sorts of breaches is not about compensation. It's about upholding the underlying relationship of trust and confidence. Okay, force it's to enforce the relationship of trust. So as a result, sometimes you can have quirky situations where the courts have awarded very large amounts for very small breaches or things that may seem disproportionate because they can do that because it's a breach of fiduciary duty. Also note that in regards to fiduciary duties with partners in particular, the High Court actually said when the relationship ceases, the fiduciary duties carry on. So, for example, if you have a partnership and you agree to dissolve it, if later on you go and make a profit that flowed from information that you obtained as part of that particular relationship, you can be held to account. You can actually be held to account in regards to those things. So just make note that don't enter into a partnership lightly under the general law. Okay. So there's carrying on a business in common. There are some factors the courts look at because ultimately you can jump up and down and say that you're carrying on a business going or that you're not. And the courts will look at your intention of what the party said, but sometimes that's not enough one way or the other. And so they do look at a variety of other things. There's joint ownership of assets, whether you've bothered to register a business name and or an ABN, or obtain things like trademarks, for example. We've got joint business accounts, we've got bank accounts, and share the ability to operate it. They look at how shared the services are between the business. How much do you get involved with the other sides, the other partners, potential partners' business? Look at the amount of capital each of the particular persons have put in. You look at how the profit sharing from a particular arrangement is, because usually in situations the courts are trying to determine whether something is merely a joint venture or has actually gone that step further, where it is a business in common and could be deemed a partnership. You look at how things have been recorded in regards to the two things, and you look at the names and whatever the public recognition of the particular relationship is. So these are the things that the courts and the tax office look at for trying to work out whether you are carrying on a business in common or not. All right, so that's partnerships in the general law. Now, if you're a partnership in the general law, either just what we call just the common law rules, where you haven't got an agreement, you're just carrying on a business in common, or where you are under the Partnership Act, that is where you do have some form of agreement, usually that it's enshrined in an instrument. If either of those things are true, then you are a partnership for the purposes of tax law. Great. But there's a third way. This is where things get messy. This is things get really, really messy. So you're going to have to just hear me out for a bit to try and work out what it is that I'm trying to express here. Because with this third way of being deemed to be a partnership, this is only to do with tax law, okay? And it is only to do with this part of the section. Because if you've got the first bit, carrying on a business as partners, so that's just the general law. That's just general. That's what it is. So we just leave that aside, okay? So this second bit though, which is I guess this the third definition, because there's two ways of doing it by carrying on business as partners. One is if you agree to, and the other one is if you're just doing it as a matter of fact. And this receiving income jointly will deem you to be a partnership only for the purposes of tax law. You're not a partnership for the other areas of law. So, for example, you don't owe fiduciary duties to each other. You're only deemed to be a partnership for the purposes of tax law. Okay, so that's something just to note. You don't need to be carrying on a business to be deemed to be a partnership under this third way, under the statutory tax definition. And look, this can come up in some pretty straightforward ways, particularly for you guys that are going to go off and be accountants. You may have this come up because if, for example, you've got two people who jointly own real property, you may have a wife and husband arrangement where they own real property and they're receiving money jointly. Okay, what does that mean? It means, according to tax law, if you're receiving money jointly, you're a partnership. Okay, now some things come up from this because you'll be deemed to be a partnership under the tax law. But in these situations, you're not carrying on a business. So you're not going to be deemed a partnership under the governing statute. Okay, so that there are a bunch of common law rules that we will use to fill in the cracks to determine where the individual interests are sitting. Because if you, and this is a general law principle, this is independent of, this comes from land law rather than from tax law or from partnership law. If you own property, so say, who we got in the class? Madison's here too. Hey, Maddie. So let's just say the four of you have a house, for example, a house or a commercial complex, all right, and it generates $100,000 worth of income in a year. Now, if you just own this, you're not in business. Oh no, that's all good. You're all good. You're all good. You getting there? So if you're not in business, you're not carrying on a business with a view to profit within the meaning of the partnership legislation. So you're not going to be deemed to be a partnership under the statute. But what does that mean? It means that we have to do this division of income. It has to go somewhere. Remember, partnerships have to have the income go somewhere. If you're deemed to be in a partnership, by default, it is in proportion to your individual interest in the property. So if the four of us own a building, but Akil owns 50%, Claire owns 30%, Madison and Rizvi own 10% each, that will be the proportion of the income stream that you will be taxed on. Where the money actually goes is kind of irrelevant, although usually when they're trying to determine what those proceeds are, where those proceeds have done, they can look at as a matter of evidence where the money's gone. And so what they've said is that, look, there's a little bit of common sense here. Merely owning a joint bank account, all right, that's not the same as receipting money jointly. Really, it's to do with the point in time where the particular legal entitlement comes up to it. So if, for example, you've got a wife and husband situation and the money goes into the a bank account which is jointly owned, but in reality, that money came from just the wife's capital contributions, all right? Or it's not going to be deemed to be joint receipt of income by default. Note that if there is a partnership under the Act and the partners haven't agreed to have a particular split in terms of income, again, going back to this building. So if instead of us just owning a building, which is passive income, not a business, if we had a business that was generating income, by default, if we haven't mapped this out in the agreement, it'll be split equally. Okay, so that's just something to note, that if we haven't mapped that out, it will be split equally and not go down to capital contributions. So the common law rule is it looks at the capital contributions, money that you put in, and this capital, that's the proportion that you're getting out of the business. That's the amount that you're getting out of the particular arrangement, which partnership arrangement. And if it's under the statute, it's going to be equal unless you otherwise agree. Because, and this is the really important bit from those that do end up in this in practice, this is the magic point. You can change this in the statute itself. In the instrument itself, the partnership agreement. You can map out where the money goes. So if we have this building and we want to have it, Akil gets 50, Claire gets 30, Madison and Rizvi get 10 each, that's fine. We just put that into the agreement. That is the amount we're going to get. And we can say whose name the thing goes into and map that out. Because partnership agreements are merely contracts. They're just rules that govern how we want this thing to work. Okay. Look, this really just extends what I was saying. That idea that if you're not carrying on a business, you're not a partnership within the meaning of the Common Law or the Partnership Act. So you still have to use common law rules for distributing how our income is, and by default, that is going to be in proportion to your capital contributions. Okay, and that's this rules of proportional interests. Which kind of makes sense in the rule in the general law. If you have, for example, each own a house as tenants in common, but the way that it was structured was that, for example, Akil had put in 50% of the money, Claire had put in 30, and the other two had put in 10 each. The proceeds of that are going to go back in those proportions as well. Those are just the underlying common rules behind that. And they make the specific point here, this is this Crepes case, that getting money jointly from rental properties is not carrying on a business. It's not the same thing. It's a pretty important point, actually, just more broadly about tax law, in that people have rental properties all the time. That is income from property. It is ordinary income, but it is not from a business. Did mention this before in the Acts Interpretations Act. Partners and companies can be companies. Partners in a partnership can be companies. However, shareholders or members, sometimes we call them, of a company, even in situations where they look like they're doing things as partners, they are not. So the shareholders are not partnerships. They can't be. It's expressly disallowed in that definition of partnership. Even if your shareholders look like they would otherwise meet the general law requirements, for the purpose of tax law, they are not going to be deemed to be partnerships themselves. Okay, right. Moving on to how do these things work. So just mentioned before to Akil, when you have a partnership, and this is the key phrase or the key piece of information you need to know, that when in any given tax year, you get to the end of the year. It's actually an important point, by the way. There's no provisional payments for partnerships. You get to the end of the year, you take accounts, you determine what the income is for that year, and then you allocate that income. You must do that when you do the partnership return. And allocating of income is quite separate and distinct from paying distributions. Now, this, for us as accountants, is a trivial thing. We know that cash that comes out of a business doesn't always have to be drawings. It's just that doesn't make sense. You can have money that comes out sometimes in capital form, but you can have it either as drawings or you can have it um, as distributions. So you could have it as you're taking money out of the business, or you could have it as the business has earned X amount of dollars, and here's your dividends, so to speak. They're not called dividends because we use that exclusively for companies. But the idea is that it doesn't matter in regards to whether there's been distributions when we're allocating this, doing this income at the end of the year. That's not really relevant. We'll talk about that in a minute as well. So this slide is probably the most important one of the whole thing. You need to know this particular rule. I've done something to my arm and it's really, really sore. It feels very strange. God, I'm going to have a heart attack or something. Oh dear. Okay. Right. How do we determine income? Well, we follow these steps. Okay. So the first thing to note is that when you are doing these calculations, you start off by taking all of the income from the partnership. So that is the worldwide income. So we are calculating the net income of the partnership as if it were an individual resident taxpayer. So we do this as if it was a natural person resident in Australia. That is the starting point. Then, once we've done that, we've worked out what the income is, then we have to work out how we split it to each of the partners. Okay, and when we do that, when you're doing it on the return, you have to show that as part of it. Okay, and note that when we're determining this net partnership income, there are some things that we do leave out. So when we take worldwide income, we leave out personal superannuation contributions, carried forward losses, and capital gains. Why? Because those are things to do with the individual parts. They're not to do with the partnership itself. That makes sense? So that so that's how that sits. You will have to go through, calculate the worldwide income, and ignore those three things in regards to doing that, because those two things are taken into account, but they're taken into account by the individual partner after the amount of income from the partnership for the year is allocated to them. They each do their own tax returns, remember. The partnership does one, and it adds the income to each of the partners based on how the thing is supposed to be split. And then each individual person goes and does their own returns. Okay, now it's quite common to have partnerships and to have in these the payment of money to people who are close to you. It's a very common thing. You have a business partnership, say wife and husband arrangement, and they want to hire their child. And that's great. It's all fair and good, except you can't hire your child and pay them $100,000. that's not going to fly. Okay, so just as an anti-avoidance mechanism, the ATO, or the commissioner, it'll say in the Act, will allow only deductions to the partnership up to the amount that the ATO considers reasonable. Okay, in situations where you're paying to a related entity. Now, if an amount is deemed to be disallowed, the other side will still receive it, but they're going to get it as non-assessable, non-exempt income, and you will not be able to claim a tax deduction in regards to that. So you, for example, in terms of paying your, you want to pay your child, and you want to pay them $100,000, but the award wage for what they're doing is $50,000, so you will only be able to claim $50,000 as a tax deduction. Okay, and in regards to that particular person, they are only going to have as income the $50,000 that was reasonable. Okay, the two things have to mirror, they have to line up. Also, there is a statutory definition of related entity. So it starts with relative. That definition of relative that we have in the Act, I think I looked at it last week, includes blood relatives, grandparents, children, step-parents, adopted parents, adopted children, stepchildren, and so on. But it also includes a variety of other things. They're really trying to cover the field here. So he said individuals who have been directors are going to be who's been a director of a company that which is a partner in this partnership. A person who's been a shareholder in something which is a partner in this partnership. Beneficiary of trust of the trustee is a partner in the partnership. The relative of a beneficiary of the trust, if the trustee is a partner in the partnership. And another partnership, if a partner in the other partnership is a relative partner in the first partnership. So you've got this quite convoluted series of steps, but ultimately this stops people from being able to do this manipulation, so to speak, and use quite straightforward income splitting, where you would just be going do and firing off income to a variety of related parties to maximize your tax benefit. You can't do that. The ATO is going to look through it, and they're going to look at things like award wages. Make note, though, just by the way this is defined, it's not designed to exclude the people in the actual partnership itself. You're always going to be, you can't be a related entity if you're a partner. Okay, so if you're paying $100,000 to your husband, but they're a partner in the partnership, these anti-avoidance rules don't apply. Yes, they are. They're a relative of yours, but they're not a related entity for the purposes of 26-35. So if you're paying a partner, so if the partnership is paying a partner to do something, from the tax office perspective, they do not care. Why? Well, this mutuality principle kicks in here. You can't pay yourself, claim income, and get a deduction. It just doesn't make any sense. And so as a result, when you are doing intra meaning inside partnership payments, these are merely changing the relationship between people in the partnership. The outside world does not care. You can call it whatever you like. You can call it a salary, you can call it drawings, you can call it interest on capital, contributions, interest paid on overdrawings, interest on loans of partnership. Doesn't matter what you call it. Ultimately, this is a mutual payment. It is an internal allocation of profit. Because it's internal, no one cares. You can just do as you wish in regards to inter-partnership payments. Partners can sort that out. And at the end of it, they're the ones that have to work out who is going to be getting what in terms of fractions of the income. So note that mutuality principle stops things from being a deduction and it doesn't count as income. So if you call an amount paid by the firm to a partner salary, and you can do that, you can call it salary, but anybody that can see me in the chat box now in inverted commas, it is in inverted commas because it's not really a salary. It's just a nominal amount. Okay, so that this nominal amount that's paid to partners flows from their own agreement, and ultimately their agreement is an internal document, partnership agreement. So that whether or not the partnership wants to pay an amount in addition to the share of profits for the year or as a component of the share of profits, it makes no difference at all. The outside world does not care. Okay. Also note this rule down here, this is in TR 2005-7, that partners can't be employees. Okay. Why would you want to make a partner an employee? There you guys, go to it. What would be the benefits of doing it? What would be the upside? What would be the downside of making someone an employee?
They'll know all the secrets of the company.
Yep. Well, in terms of tax benefits, though, would there be any tax benefits or disadvantages from having a partner and making them an employee, so paying them a salary? Because what do you do when you pay salary? What's a bunch of other things or factors that you've got to do when you're paying an employee? Must pay them super. Yeah, that's right. Ultimately, that's still kind of a payment, so to speak. So we could still justify that, although it's kind of annoying because you're doing this and you've got to do this every pay period, weekly, fortnightly, whatever have you. That's all right. Yeah, ultimately, the partnership can choose whatever they like as what the hourly rate is for this for doing this. Because the difference is if you just have an inverted commas a partnership salary, or the partnership just saying here's a bunch of money, or you're having and paying them as an employee. When do you pay tax? If you're paying if you were an employee, when is the tax paid functionally?
When you earn more than a certain amount,
Yeah, but assuming that you will, let's say you've been paid, I don't know, $2,000 a week. When are you, the business, the employer, the partnership, when are you paying this money off to the ATO?
during tax period.
Any advances on that? Has anybody ever done payroll? Claire, have you ever worked doing payroll?
You have to pay your PAYG.
You've got to pay your PAYG. That's Maddie that popped up. Yeah, so that if you're paying someone as an employee, you've got to do this every flipping reporting period. When you do your base and you do send off your PAYG every fortnight, a month or maybe quarter for small employees, but you've got to do it regularly throughout the year. And not only that, what was something we talked about last week? If you have employees, quite a few employees, what's another thing you have to pay? As the employer, when your wages bill goes over $1.3 million per annum.
Payroll tax.
Payroll tax. That's right, it's just a tax. So if you're paying someone as an employee, you, yeah, you kind of have to do it. Now, it's possible that there's actually these things get sent back and included back in payroll tax anyway. But the key thing is that you get to do it at the end of the year. You are not liable for anything until accounts are taken. And assuming that no one enters the partnership, leaves the partnership, or dies, that's going to be the 30th of June. And so that's the reason why you want to be paying essentially, if we can call it salary or we can call it distributions or drawings of the partnership, it doesn't really matter. But ultimately, you don't want to have them as employees throughout that process. You can't. And in fact, the tax office actually say you can't. It just doesn't make any logical sense either. But you wouldn't want to anyway, even if you were allowed to, because it's so much easier to just get your money. Because remember, it's your money. Like I said, if you guys, no one here has had partnership. Madison, have you ever had a business partnership?
No.
You haven't. Okay. It's one of the things about them is that they're real easy compliance-wise. You don't have to pay any money to set them up, and once you've done it, you've got the usually partnership agreement. You just go down to the bank, set a separate bank account up, done. It's so easy. Oh my God, it's so easy. Doing companies and trust is so much more drama. And so the upside of that is that if you've got a pool of money, when you need money, just do some drawings. Just draw it down. Fine. It's all balanced out at the end of the year. That's when you go and do these sorts of adjustments for doing things there, and it makes life just so much easier from a bookkeeping perspective. You've got one fewer employees. Anyway, drawings. Oh, there we go. Drawings. There we go. That's essentially why do stuff that I'd said as a precursor. Look, this fact that partnerships, you can't ascertain what the profit is until the end of the year from a business perspective is just great, because that means that you don't have to pay tax on that until the thing's done up, which is different from PAYE, PAYG stuff. Okay, and look, from the firm's perspective, from the actual partnership itself, if you want to withdraw cash throughout the year, sure, that's fine. It's just an advance. It's just an advance on the profits that you're going to get towards the end of the year, possibly capital. So fundamentally, that's just a loan by the firm to the partner before you've actually worked out how much profit they're going to get at the end of the period. That's all that is. And it's just a journal entry from the accounting perspective. You take the money, go for it. Okay, so the drawings are essentially taking money from the firm ahead of the end of year taking of accounts. And this idea of having interest for capital contributions is essentially the same thing. It's still a mutual payment. The fact that you can say and put in your partnership agreement, ahead of distribution, all partners will be paid 10% of the amount of capital on the capital they've put in. And you could pick an arbitrary number. It doesn't matter. It's a contract, so to speak. Those numbers you pick, the courts don't care how fair it is, because ultimately it's the arrangement that the partners themselves have come to. But note that because this is an internal arrangement, this interest, this inverted commas interest on capital contributions, it's a mutual payment. Yeah, it's neither deductible nor is it assessable income. It's just not. It's just neutral to those things. You're just working out how to allocate the amounts that are going to be paid to the various people, or income is going to be allocated at the end of the year. Okay, however, as something of an exception to this, partnerships can have situations where partners lend money to the partnership and interest is paid. And in that situation, provided that the amount of interest that's payable is comparable to a market rate. So it can't be way too high and it can't be way too low. If it's roughly market rates, then that is deemed to be an arm's length transaction. So the partner is being paid, but they're going to be paid that amount that they're paid as interest is going to be income to them, not the partnership. It's income to that particular person, that partner, and the partnership itself gets a tax deduction of that amount. It's just an ordinary deduction. Does that make sense? There's a distinction between these sort of internal arrangements that you have and external ones, or arm's length ones. You can have an arm's length situation where you lend money and you do it for an appropriate amount. That is fine. So once you've worked out what the net income is, and then you've taken into account all of these internal, inter-partner transactions and done those, then you get to allocate the amount of income to, or loss in some situations, to each of the partners. And notice my sentence, don't know the way I've written that sentence, but the idea is that it's the third step. Calculate the income, work out what the intra transactions are to work out what each partner's share is, then you allocate the relative amount of income or loss to each partner. Okay, here's where a bit of strategy comes in, because if you're a resident partner, the amount of share you're going to get is just going to be added to your income. Right? There's no negotiating about that. However, if you're a non-resident, remember that non-residents are only taxed on what? What's the difference between a resident and a non-resident? Non-residents are only taxed on absolutely only income that's sourced in Australia. So if you're a non-resident and you're being paid a whole bunch of money, if you don't map this out in the partnership agreement, you'll be given a proportion of Australian attributed income and foreign income. So let's just say that the four of you are partners, all right? There's $1 million worth of income to go. But let's say, Claire, you are living overseas. And if the $1 million of revenue that we've got, if 200,000 of that is sourced from overseas, if we don't map this out in the partnership agreement, 80% of the income that goes to each of Akil, Maddie, and Riz, 80% is going to be Australian, 20% is going to be foreign. But ultimately, if you're Australian resident, it doesn't make any difference because you're taxed on worldwide income. But that matters for Claire. If you don't map that out in the agreement, you'll be given a income which is 80% Australian sourced and 20% foreign. So you're going to functionally have to include 80% of that amount in your tax return. That is if the partnership agreement is silent. However, you actually can put in the agreement that we will allocate certain income streams to certain people. So you could take, what was the example I had, $1 million and 200,000 of that is foreign, and say, hey everyone, we're going to allocate this $200,000 of foreign income only to Claire. All right, and then she'll also get $50,000 of Australian source income. Yeah, sure, you have to pay tax on that. That's annoying, but that's life. And the remainder is allocated 250 to each of us. You can pick which particular packets of income to go through and apply, but only if you've done so in the partnership agreement. Does that kind of make sense? I know there's lots of little bits of information, and last week's was way too many bits of information, but there's relatively fewer bits here. But this process of allocating income and this process of determining net income for the partnership, looking at the intra transactions, and then applying it. Just one little rule that you can note is that if you've got an agreement, you can apply particular income streams to people, but only if it's mapped out in the partnership agreement. If you haven't mapped it out, it's going to be proportional. You've got no choice in that, and that's the general law rule. Okay. Right. Oh, yeah, well, I seem to be always one slide ahead of where what I'm sort of wanting to talk about, because those rules, that's exactly just as I'd said, that idea that you yeah, things are proportionally done. Sorry, I probably should click the slide a little bit earlier. Oh, losses. Okay, this is one big difference between companies and partnerships. So if the four of you were shareholders in a company and the company made a loss, boo-hoo. That sucks to be you guys. The company can keep the loss and roll it forward, but you as individual shareholders can't benefit from that. Whereas if you are in a partnership and it makes a loss, subject to the rules in Division 35, which is the non-commercial losses rules, subject to that, leaving that aside, you would be able to, in situations, particularly where you've got a lot of revenue for your partnership, to be able to offset the losses against other sources of income you have. Okay, and this again is usually mapped out in the partnership agreement itself. If you haven't mapped in the agreement, you use the proportional rules in the general law. That's where that is. If you don't have an agreement, yeah. And yeah, okay. Just make note that you can't min-max this. So you can't have a situation here. Say the four of you are in partnership, and the firm's made, I don't know, $1 million. But if Claire had the situation where she had a a large amount of income, you'd made $3 million somewhere else, and the rest of you guys had low, I don't know, tax losses or something you wanted to use. You couldn't have a situation where you allocate income to some partners and losses to others. You can't do that. Where you've got negative numbers and bits and pieces. If there is net income to the partnership, then income is to be applied. If it is a net loss to the partnership, the loss must be applied. Okay, and much with the same as income, it has to be applied. You have to actually push it somewhere. Okay, franking credits. You guys know anything about franking credits? We're going to do it when we do companies taxation in a couple of weeks. Everyone vaguely know what a franking credit is? I'm going to explain it now because this is a handy thing to know now because I'll do it multiple times. So if you have a company and that company makes, we'll say, $10,000. You've got a closely held company, all right? And let's just say at the end of the year, you got to pay some tax. So the company pays tax. What's the company tax rate? 26. Yeah, I think it's 30 for the large entities. I think it's actually going, is either going down or gone down. It was 27.5, and I think it's going down to 25. Let's just check that actually. I'm not sure whether it's this tax year or not. I mean, we have actually literally done it in this course, which I find kind of funny. It is 25. That was 25. So yeah, right. So last year it was 27.5. This year it's 25. So if you do that, so how much tax are you going to pay there? $2,500. Good work, team. So we're going to pay that much in company tax. Cool. So that gets that then gets sent off, off to the ATO. Okay, great. However, what happens is that on the books, that $2,500 stays with that company as a franking credit. Does that mean? It means that that can be passed on. And so that if we were going to do a distribution, and again, we'll consider this to be a $10,000 distribution, all right, and this is going to go to the four of you as a partnership. So I just got the P-ship, the P-ship. All right, this, you're going to get given a distribution from that company. Now, when you get given the thing, like physically get given it, you will get a bunch of cash, which will be 7,500 cash. 7.5. Oh gosh, I should have probably written this out. Plus and this is an important thing to note, this you'll get in the form of cash. Yay, there's a $7,500, yay. But you get attached to that. I like to think of it as a paperclip. Oh, I'm not going to try drawing a paperclip though. Oh, that's not too bad actually. Attached to this check for $7,500, you will get a document that's called a franking credit. And what's the amount of that? 2.5. So you'll get given 7,500 cash, 2,500 as a franking credit, and you add all of that together to put into your income. So the partnership income from this distribution of $7,500 cash plus $2,500 the franking credit is still going to be $10,000. Okay, you need to get your head around that. You need to get your head around that real fast, because this is how the imputation system works. This is how company tax works in Australia, and it's a really important thing to know. It is different from other places, because we think in situations, and this is part of the underlying rationale behind this, we think it's really dumb if you've got one company that owns another company, that owns another company, that owns another company. We think it's really stupid. And then ultimately, this is owned by, there you go, it can be owned by Madison, MB. Let's say you own that one there. It'd be really dumb if you had a situation here where this one pays dividends to that, and then this one pays dividends to that, and then this one pays dividends to that. This is what they do in the US, by the way. Pretty dumb. So if you were clipping that 25% each time, what's the amount of money that Maddie would end up with at the end of this? Not very much. Not very much. You're effectively taxing at sort of 70 or 80% on distributions if you've got a situation where you've got a corporate entity that owns shares in other corporate entities. That's stupid. That's why we have the imputation system. And we'll talk about this in 2 weeks' time. But we need to know here how this works functionally, because when franked distributions are made to partnerships, obviously you include the full amount, so the franking credit plus the cash as the distribution. And that's not the controversial part. Controversial part is how do the franking credits get distributed? Because the thing is with franking credits is that they can be used to offset tax, and in some situations they can be refunded. But I don't know who was here in 2019. Claire, I don't know if you remember that election. That in 2019, it was, thanks Rupert Murdoch, was completely fought over. It was essentially a pass-away Labor policy on franking credits. Most of the population don't know how franking credits work, and so it was, the whole thing was stupid, but still cost them the election, they reckon. Usually, franking credits and offsets could only be used to offset payments of tax. The idea being here that in this partnership, if this was distributed, and let's just say it gets distributed to Akil, if Akil is on the lowest marginal rate, you're below the tax-free threshold, you would get $7,500 cash, and you would put the $2,500 credit in your tax return. Now, usually with offsets, you can't get them refunded. Franking credits at the moment can be refunded. So you would actually, literally, when you're doing your tax return, you would just get $2,500 back from the ATO. If, however, you're on the top marginal rate, it's not going to help you anywhere near as much, because you've just added $10,000 income. What's the marginal tax rate, including the Medicare levy? What's the top rate, including Medicare levy? 45. Yep, plus the Medicare levy is 47. Yes. So you have earned another $10,000, which means you've got to pay $4,500 cash. Now, sure, you've got this credit of $2,500, and that will go towards the 4.7 that you've got to pay, but you've still got to pay $2,200 in additional tax. There's no escaping that part. And so that's why it's a little glib when they talk about reducing increasing and reducing company tax. Increasing company tax, it does have some effect, but the imputation system blunts that quite a lot because it's a pass-through mechanism to the ultimate owner of things. And it's important for us here in terms of partnership. Oh, there we go. Basically, 22.5. Yeah. It's 25 this year. Yeah, good. You're probably looking at the same thing as me. I think I've got it here. Guess.com.au, I think it is, or whatever the first thing came up in Google. So when a partnership receives a frank distribution, it's getting the money, all right, and it's getting the franking credit. So it's $10,000 worth of income, goes into the net income. Then it's got to distribute it. Now, the exact same rules that I talked about for non-residents. So if Claire was the non-resident, we'd want to put the income streams towards her. The exact same rules apply for franking credits and those distributions. By default, it's going to be put out to the proportion of capital contributions. That's the generic rule as part of that. If you've got an agreement, the agreement can map out where that particular distribution goes. And so in that situation, particularly if it was, say, the four of you and you knew each other very well and you got a frank distribution, you would want to give it to the person who's going to get the most tax benefit from that. Now, at the moment, franking credits can be refunded anyway, so it's kind of a moot point. But you would normally give it to people who have tax to pay. That's really where it would go. You'd go through and do that. If they weren't refundable, which if Labor wins, and there's a good chance that they will in the next election, if they do go back to being non-refundable, then you definitely want to put it to a person who's on the top marginal rate, not the bottom rate, because that can go to offset tax that would otherwise be payable. Okay. It's frank distributions, and again, we'll come back to that in a couple of weeks. It's probably a good introduction, actually, to that. Get your head around that at this point. Okay, anti-avoidance stuff. There's two important pieces of anti-avoidance we want to talk about here. And the first is what we call passive income. Technically, it's called uncontrolled partnership income. Don't know why this exists. I should have asked Steve while I was here. No, Steve's not there. Boo. Basically, if you have a situation where you've got one person who's functionally doing everything, and the other person is an adult who is still deriving income, but has no idea what's going on, all right, they're taxed at 47 cents to the dollar because this, just as an anti-avoidance mechanism, look, it actually doesn't come up very much because it's quite a hard thing for the ATO to prove. However, sometimes people will put in writing statements that they didn't know what was happening. So I have had this quite recently, actually. My ex-partner, life partner, we also had a partnership. And despite the fact I tried to explain it to her like 10 times, she just didn't seem to understand what and when and how this worked. And when we separated, which was amicable to start with, less so over time, yeah, family law is not great. When she's trying to explain this to her lawyers, her family lawyers, she can't. She can't explain it to them. And it's, yeah, it got a little bit problematic because this rule might have come up. Now, as it happens, the way that partnership was set up, it was actually, I at the time was the low income earning partner. So it wouldn't have mattered quite so much because she wasn't having income applied to her. But if the reverse was true and she'd put on record that she had no idea what was happening, that could be problematic because the ATO can and do, if armed with that information, change your assessment. They'll actually just issue a new assessment. So that's something just to note. And look, it's one of those things. If you guys are going to be advising people in terms of structures, when you're talking about partnerships, you need to know this rule because you will have people that are, a wife and husband arrangement where she's got all the brains and earns all the money, whatever, like that. He doesn't do anything or know anything about it. And this rule, you can fall foul of it. So you just want to tuck that one away in the back of your mind. Okay, the other area is minors. Now, oddly, when I was doing the lecture, somebody said, oh, what's the minimum age you need to be a partner? I'm like, oh, it's 18. And they're like, hang on, my next slide is about the income of minors. It's definitely not 18. You can definitely have partners in a partnership who are minors. Okay, you can absolutely have that. However, there are some challenges here if you have minors in a partnership, and that is because what's the similarity between this as an anti-avoidance mechanism and all of the rules we have for cell phones and not being able to claim that, and home offices and not being able to claim that, and clothing and laundry not being able to claim those as deductions? Why do we have all these rules? It's because we all have clothing. We all have cell phones. We all have cars. Now, technically, we don't all have all of these things. And technically, we don't all have children. Something I wouldn't wish on anyone. I've literally abandoned my child at home. He's doing his own thing at the moment. And I've just put that on record. Great in the recording. Good work, Simon. And with minors, though, they can be partners, but we don't want a situation where everybody is setting up partnerships and everybody is making their, my 11-year-old child a partner. And the reason and the way they go about doing it is this stuff. It's this stuff here. So these are the rules that apply. It's actually not just for partnership income, although it's a good place to include it because it used to be quite a common mechanism, a way people would use this to avoid paying tax. So it goes like this. There are punitive rates for minors earning money or earning income, deriving income. Okay, and those punitive rates are in these unearned income parts of the old, it's the 1936 Act. Now, there are two types of exemption that come from that, and they're called exempted income or exempt, I can pronounce it, or the minor is an accepted person. I don't know why these slightly different language, but they do. So you've either got exempted, and it's different from exempt income. That's a different definition again. So in regards to this, either the income can be exempted or the minor can be accepted from paying this punitive rate. And so that basically a young person who's left school, they're functionally working as an adult. If you left school, you're not studying anymore, you're going working in a job, it's pretty stupid if you couldn't receive passive income without, as a not receiving it as an adult. It'd be really, really mean, in fact, if you saved hard as a 16-year-old, bought a whole package, a bunch of shares, and then derived income from it, and then you weren't allowed to do it, even though you left school and done other bits and pieces, because that a law is set up to allow people from an early age to do a bunch of things as an adult, even though you're not technically an adult until you are what age? It's the age of majority in the state of Queensland. Yeah, I just realised it's actually on the bottom of the slide. So that's it. On your 18th birthday, you're legally an adult. Personally, I think we should stagger a whole bunch of things out even further. I'm a big fan of that because the human brain doesn't finish maturing until you're like 25. And to be honest, Claire, I imagine you're on this side of 25. I'm quietly confident that I was certainly not a real adult at age 25. Probably still not. So you've got accepted persons. So those are people who fall into these categories. Look, if you've finished full-time study and are working full-time on the last day of the tax year, you tick the box. You can derive whatever income you like. You're not subject to these rules. Similarly, if you have disabilities, if you're functionally disabled, or, and this is a little bit sadder, if you're entitled to a double orphan pension. If both of your parents have died, you are an accepted person for the purposes of these things. And in addition to this, a person who is not accepted, so my child, for example, is none of those things because he's only 11. Assuming that you didn't meet that, some income streams are still going to be exempted. That is employment income, business income from their own business, Centrelink, and income from deceased estates. So those 4 types you're still going to be able to receive without them being punished, without you being punished, because the punitive rates are pretty strong. So if you aren't an accepted person, so assuming that you're a non-accepted person and it's non-exempted income, so it's none of those categories that we had in the previous slide, guess what? The first $416 you get is tax-free. Yay! The next dollar you earn above 416 is taxed, I kid you not, at 66 cents to the dollar. 66 cents. That is the marginal rate you pay for the next however many dollars it is. And this is a change that's happened relatively recently. They've actually gone to change this. Once you earn one more dollar than 1,307, so you've exceeded that amount, all of your income, so it's not marginal, all your income from that point forward is 45 cents to the dollar. And look, if you actually go and do the numbers, 1,307 is the point in time where if you were taxed 0.45, it's going to be 45% of the amount that you've got. So you're not actually losing out. It's not a big jump when you earn one more dollar. It just means from that point forward, you're effectively being charged 45 cents to the dollar for everything. Now, there's no Medicare levy, yay, in regards to that. But still, that's a very high rate of tax, and that is to prevent people from moving money around. So that works. Okay, note that if you're a non-accepted minor, so say my child, for example, so he has hilariously actually has business income, even though he's 11. That is accepted income because it's his own business. But if he was also getting income stream, so interest from, actually could be even interest from his own bank account. Wow, yeah, interest from his own bank account, that will actually be taxed separately. So the exempted income is taxed at normal marginal rates as if you're an adult. And the remaining income is the non-exempted income is taxed using these rules. Okay, so you just do them separately. They're 2 separate parts in tax return. So yeah, and accepted minors. So if you're in those categories, if you're a double orphan, disabled, or you're working full-time and have left study, and at the end of the tax year, then you're just taxed as if you're an adult. That's where that is. Does that kind of make sense? Those are the rules for minors. It's one of those things you find. This is a piece of it's not really legal trivia. Tax law is made up of lots of little rules, little bits of information. And that's why I'm saying there's no high level principle here. You've just got to know each of the individual rules, sadly. Yeah. Okay, CGT. Thankfully, or maybe not thankfully, CGT happens to partners, not partnerships. Okay, so you need to map this stuff out, and really, unfortunately, and Steve's got this in his notes, which are in LendJCU and the BX site. Really unfortunately, this means that it can be a little complex, because when a partner leaves a partnership or joins a partnership, that partnership, again, I think you can actually map this out in the agreement, but by default, that partnership will dissolve. Okay, and you are creating a new one at that point in time. What does that mean? It means that assuming that you've got equal share in each partnership asset, each time that happens, a CGT event happens. So for example, let's say the 4 of you guys, you've got a building. We'll say it's $1 million. 1 million, great. And there's 4 of you, so you've each got 250K's worth of value in it. Okay, and let's just say that it got purchased for half of that, 500K a few years back. Great. What happens if you introduce me as a partner? Well, now I'm going to be here. This doesn't change. It's still worth $1 million. However, each of your shares have changed. So you have effectively relinquished, what's that? Because you're going to go from having 250 down to 200 each. So you've effectively relinquished, disposed of 20% of each of your shares. And so if each of your shares are worth that, you have essentially disposed of $50,000 of an asset. And we would have to go back and work out, that's the proceeds, functionally, $50,000, because we have to use the market value substitution rule, even if that's not the amount that I'm paying for the goodwill, so to speak, to buy in. And then you'd have to work out what your gain was, assuming it's that. But there, so they go back, work out your cost base, 25. So that's going to be ultimately here, that's going to be a 25K capital gain, subject to discounting. But that's really annoying. That's really, really annoying. And don't get me wrong, I would have to compensate you probably as part of entering into this arrangement. But that's where it's at. And so that you want to have situations with CGT and with capital assets going into partnerships, having the things very carefully mapped out in terms of whose name is on which asset as part of that, because it can turn into something of a nightmare if you're going to have CGT events triggering every time people are coming in and coming out. Okay, so that's just something to note. All right, assignment. Assignment is where, look, you may or may not be aware, in law, you can, if you own stuff, I own this coffee cup, it's empty, good. I can assign this to another person. I can say to Dr. Yan, who's over there, this is now his. Sure, done. You can gift things, you can sell things, you can dispose of, you can destroy them. That's what some of the indicia of property rights generally. And because this is a physical object, you can see that. You can also do similar things with intangible rights. You know, if I own copyright in something, or I own a packet of shares. I know in law we call those intangibles, in the accounting world we don't, but leaving that aside. So one of the types of property that can be assigned, again, either for value or you can just do it one way, are beneficial interests. So the beneficial interest is the it's the right, basically it's the good bit that you get. In regards to a partnership, that is the right to have the income stream go to you. And so that beneficial interest, in the olden days, you could do what's called an Everett assignment. Now you can still do these. It's not coincidence, by the way. This case is the Commissioner and Everett. You could do these things, and they jumped up and down about it. The tax office, ultimately, the tax office lost. The court said, yes, you can do these things. Now, you can still do these things. You can still go and dispose of your beneficial interests. However, that is subject these days to capital gains tax. So it's not used to the same extent that it once was, because you've got a variety of things. You've got, and the market value substitution rule kicks in if you're doing that. The other thing to note is when trying to work out what your cost base is, if you're disposing of your interest in every assignment, you don't have a cost base. So therefore your capital gain for the person receiving the interest is going to be quite large as a result of that. Okay, so that's Everett assignments. And look, the rest of these things I've talked about assignment. There's that kind of goes back to the previous slide about the fractions. You get fractions of capital assets when people come in or out of the partnership, and the same thing can happen if you assign it. If you take your beneficial interest and assign it under sections 199 and 200 of the Property Law Act. Okay, so what happens when, well, when one of these things happens? Partnerships dissolve, so they end. Look, when I say they end, this doesn't mean the business stops. You don't usually have a situation where, if a partner comes in or a partner leaves, that everybody goes home. That's just not how businesses function. If you have a law firm, for example, it's as in the form of a partnership, and one of the people retires, they get their little, I don't know, cake or whatever like that. You don't stop what you're doing, and that's just functionally not how it works. Usually the business carries on, but technically the partnership dissolves at that time. It can also dissolve when the partners agree for it to dissolve, when a new partner comes in, or when a partner leaves or dies. Okay, and if you're doing it by agreement, or you're about to introduce a new partner, or you're about to retire an existing partner, you can pick the date. You get to pick the date when that happens. All right, and the courts and the ATO are flexible, provided you're not silly about it, which is what happened in this HAP case, where they picked a date that was 6 months in the past, on the 30th of June, to reap all the benefits. The ATO and the courts didn't like that. So you can pick a date, though. If you're going to do it in the future, and do it sensible. You can make it the 1st of July. That's the date that Steve Gore retired on, of course. When would all tax academics retire on? The 1st of July, obviously. So just note that if a person dies, you don't get to choose the date. So that's just something to note. It's the other ones, introducing, retiring, and doing it through agreement. But when those things happen on those dates, and at the end of the financial year, each financial year, you must take accounts. So you have to determine what the amount of profit or loss is up to that point. So when I said that accounts have to be done at the end of the financial year, and it's great because it means you don't have to count profits, work out where things are at, and allocate income, well, that's a half-truth, because you've also got to do it when the partnership dissolves as well. Now, this is why, going back to that previous slide, where if you're choosing the date, it's a really good date to choose to choose the date, which happens to be which date? So you don't have to do this twice. What's the best date to choose? Choose that date, and that way you do your accounts once. Look, it's probably not so much a big deal these days with software, but note that if you've got a lot of contingent things, again, most of you guys are accounting types, you appreciate if you've got things that need to be valued, assets that need to be valued, that's going to be a pain in the proverbial behind, because you want to be doing this as, particularly for small entities, which a lot of partnerships are. You don't want to be doing this all the time. Thankfully, you don't, with small entities, you don't have partners coming in and going out that often. Yeah, so that's where that is. All right, so taking accounts. Okay, we're almost done with this stuff here. So I'll just quickly talk about some of the advantages. Look, I've increased, anybody's watching this who's watched either was in class or watched the early one, I've chopped and changed these slides a little bit, because I didn't put some of the important taxable reasons for having partnerships. So partnerships have the upside is that they're dead easy to set up. You're almost always want to actually get a proper instrument, a partnership agreement, and map that out, but you don't have to. And you can even start the thing orally, and then say, look, but we're agreeing that we will enshrine this in writing at a later stage. That's fine too. It's a super easy way to go through and do those things. This doesn't have any setup cost, and you do not need to register them. So there's this limited external regulation. I don't know if any of you guys here set up a company recently? No, no one's done that. It's like $600, and you've got to pay an annual fee. And in fact, I can tell you, I'll even put it on the, let's have a little look. I'll put it on the screen if I can find it. Can I find it? Can I find it? Can I find it? Let's have a little look. See if I can find the annual fee. Quite curious, actually quite curious just to see what it is. Annual fee, here it is. This is the annual fee. Put it on the screen there. Now that one there. It's that much. Can you guys read that? Hopefully that was readable. $273. Yes. And so that is, yeah, very, very annoying. Very annoying. So you have to pay that for companies every year, which sucks. And look, I don't want to be one of them. And Kiwis seem to love ragging on Australians, and I've got no idea why. Australians don't seem to have the same sort of problem. And, they have the stupid sheep jokes and other bits and pieces, but and I think it's the whole, big country, small country thing. Americans and Canadians, Sri Lankans and Indians, and Scots, and all other English-speaking people. But there is one thing that I'm really just big on and passionate about and kind of angry about, is the difficulty in just the technical aspects of entrepreneurship. How hard is that? Because $273, that's a non-trivial amount of money. And particularly if you wanted to get into it as a young person and get started, you have to set the thing up, which is, I think it's $575 at the moment, as a setup fee, and then you pay an annual fee of that. And look, when I set a company up in New Zealand over 20 years ago, it was $50, and you could do it online. It took a day, and there was no annual fee. It is actually a little bit more expensive than that now, and you could do it on the internet. You've been able to do it on the internet since the 90s. It was just so much easier to do this across the Tasman. And look, and I do appreciate, yes, there's a whole bunch of regulation here, and there's federal, state things, and other bits and pieces, but it's almost like they're not trying very hard to encourage people, or even worse, actively trying to discourage people from being entrepreneurial, going out on your own and giving it a go, even just in your spare time. Because things like that, $273, if you're just doing this as a hobby, that's just stupid. So anyway, I'll end rant on that particular thing, because you've probably, those that have had me teach them before would have heard me go off about this in the past. And all right, so going back to that. So the upside of partnerships, easy to set up. You have the benefit of, general purpose things. You've got combining skills, and you can combine financial resources, which is nice, which is better than, I suppose, a sole trader. You do have more flexibility in terms of tax planning. In particular, you've got the ability to allocate income. And again, if you've mapped it out in the agreement where you don't have to do it proportionally, you can just pick and choose. You can pick and choose each year. Wow, it's a great thing. And you can allocate losses. You can actually distribute losses for partnerships. So some year, particularly that the idea of the tax year as a phenomenon is kind of artificial. If you make, sales, but you make a big sale every few years, it's going to be a little, tax years are almost silly in terms of how and where they sit. So some years you're going to make a great amount of income. Other years you might make a loss, and being able to offset that against people, for example, who may have PAYE jobs, people who might have well-paid jobs, You may be able to minimize your tax by having a partnership that you can allocate losses in certain years. You've still got to take into account the Division 35 rules, the rules for non-commercial losses. But one of the ways around that is to actually have a decent amount of revenue. If your business is making, has turnover of more than 20 grand. Yeah. Okay. And it's, yeah. So the, what else have we got there? Accountability. Oh, yeah, this is one of those things that I've put it here in the advantages, but yeah, it's a two-edged sword. Because of the very, very high level of duty that being a fiduciary places upon people in partnerships, because there's a very high degree of people being able to stuff each other up, so to speak, in partnerships, it makes people, in theory, gives people an incentive to be very vigilant about checking what your partners are doing. So there's a high level of accountability because you're making everyone else liable for doing things. So that's the thing. It's easy to dissolve partnerships and leave. You can just leave by saying, I don't want to do this anymore. That's one way, and that you get dissolved. Now, a whole bunch of these things, the corollary is just the exact same thing. So, for example, the fact that there's a high degree of scrutiny and accountability, that's because you're all liable for each other's debts and stuff ups. So if you've got an incompetent partner, you go down with them. One of the lovely, beautiful phrases that the very delightful Mrs. Salome Pretorius, who's taught law here for longer than me, she gave me, and it's a piece of information which I've known for a long time, is that I first had a business partnership in the millennium, so I was 22, and that is that all partnerships are sinking ships. They sink at different rates, but ultimately they're always going to end. One of the key things about partnerships that is distinct and different from companies is that partnerships involve people, and people are fickle things. Partnerships do not have a continuous, what do they call it, succession. The phrase has escaped me. Companies do. Companies can hang around for as long as people keep paying the $273 annual registration. Perpetual succession? No, perpetual, I can't remember what the phrase is. But partnerships don't have that. And if you're in business with people, you should always remember what it was like at university doing group work. And the perils of being in business partnerships with your friends, it's very rare for people to still be friends afterwards, okay? Because you're mixing and matching money and stress and responsibility. And if you think about housemates in terms of how clean and tidy they are and how there's the mismatch between levels of tidiness. And let's face it, we've all had friends come and complain to us. Oh, this particular person didn't do this or didn't do that and didn't do this. And sometimes you're listening to your friend complaining. You're like, wow, I would never have done any of those things. That's why I'm so glad I don't live with you. Business partnerships are like that too. The expectation people have, there's no universal objective standards for doing things. They're always going to be subjective, and the longer you're in them, the more you diverge in terms of, often you've also got you diverge in terms of life and what you want, because you're never the person you went into the arrangement. You're a different person at the end. So just tuck that away in the back of your mind when you're going into partnerships, and it's all fine and well and good, but these days I would be very, very unlikely to jump in partnership. Well, admittedly, I have, but actually with a friend of mine, but that's pretty low risk because we've done literally zero things. But it's very, very unlikely that you want to go through and have serious endeavors over the long term as partnerships. No, there's a couple of other tax things too. With partnerships as opposed to companies, if you earn business income, legitimate arm's length business income as a company, and you tax at 25 cents to the dollar. With a partnership, you've got to pass it through. So if you're passing it through to you and all of the partners are on 47 cents the dollar marginal rates, you're not getting much tax benefit from that. Whereas if you own companies, you can leave your money in your company if you've got a closely held company, pay 25 cents to the dollar and just leave it sitting there. Sure, you're building up franking credits. Sure, you're not passing those things out. Sure. But if your marginal rate's 47 cents to the dollar, you can leave those retained earnings inside the company for as long as you like. Make a capital gain at some stage later if need be. So you do have that benefit in having a company as opposed to having partnerships. Yeah, doesn't have legal personality. They're suing you. They're not suing the company. The partnership is an entity. Unlimited liability. If the thing goes pear-shaped, you lose your house. If your company goes pear-shaped, what happens? What do you lose? So if you've got a closely held company, you lose nothing. Yeah, well, I mean, you lose, in theory, the amount of paid up capital you put into it. I mean, that one you saw there has $300 of paid up capital into it, which I plopped in however long ago. Yeah, I'll lose my $300. Ooh. Yeah, I'll lose about 1 year's worth of annual registration. Sorry, I'll stop harping on about that. Okay, yeah, disputes are a big thing that comes up. Okay, corporate limited partnerships. These are taxed as companies. All right, so they are actually referred to as partnerships in the tax legislation in places too, or corporate limited partnerships wherever they are. But they are taxed as companies and not as partnerships. Okay, so just make note that because of that, they don't get the tax benefits of partnerships, which is to distribute income through there. They carry forward losses to subsequent periods. Okay, the last thing I want to talk about are joint ventures. A joint venture is not a partnership. And joint venturers do not usually owe each other fiduciary duties. Now, the distinction that you have with a joint venture is that you're doing a particular project. You are working together with another entity, or in theory could be more than one entities, to achieve a particular result. And you both obtain a share of that result. Okay? That is different from carrying on a business in common with view to a profit. Okay, those are two different and distinct things. And it comes up a lot in the natural resources. So the big miners do this. So for example, Rio and BHT come together. We're going to have a joint venture to build a wharf at, I don't know, one of the ports in West, what's the little mining town in Western Australia that everyone flies in and out of? I can't remember off the top of my head. South of Broome. Oh, it escapes me. Anyway, it's where you have a situation where you've got large entities come together. They're not wanting to be partners. They don't want fiduciary duties in regards to each other. They don't want to be held liable for stupid things that the other one does and contracts and wrongdoing that the other one does. They just want to be dealing at arm's length on a contractual basis to reach a particular result. Okay, and the idea is that joint ventures have their own costs, they undertake their own operations, and they don't lodge tax returns together. Okay, they don't, there is actually a thing for GST groups. When you're collaborating, you can have GST group together, but that's the key thing to know. Now, however, this rule here in UDC and Brian goes like this. Ultimately, joint ventures and partnerships are creatures under the general law, okay? And if you are doing functionally operations where you're acting like partners, the law will treat you as partners, even if your agreement says you're joint venturers, okay? So, for example, this is my little example here. There's my little whiteboard. And apologies to those that had this in class. I'm going to use the same example. Let's just say we've got a hill. I'm going to make the hill green, which is really funny because they're usually red, Western Australia. All right, and on this side, we've got BHP. Yeah, probably not a good example because they have expensive lawyers and know what they're doing. Over here, you've got Rio Tinto. All right, and we go, hey, this hill's got a whole bunch of gold in it. I don't think either would do much gold mining, but that's by the by. Okay, see where I'm at? So far, here's our gold. Here's our gold. It's under the ground. All right. Okay. How about we go halves on the tenement, and I'll dig a hole on this side, you dig a hole on that side. But all we're going to do is go halves on the tenement, all right? And then we'll dig the gold, and we'll just, each side gets to keep the amount that they dig out of the ground. And you go, okay, sure. Let's go halves on that. That's a joint venture. Okay, you guys agree? It's a joint venture. It's an arm's length thing governed by contract. Nothing carrying on a business in common. Does that make sense so far? Does that make sense? Anyone? Yeah, got it? Okay, good. All right, let's just say now that as part of doing this, they're like, oh, how about, it's quite expensive to get staff in and there and out, and you're running these things, and it's tricky to do. So how about we get this so that you have staff that can work over here, to do overtime, for example. Not that happens much in the mining industry, but if you want to lend staff, you've got additional staff to go here, and we've got additional staff that can go here. How about we do some swapping of staff to fill in the gaps of our labor from time to time throughout the duration of this project? Sure, it's probably still joint venture. Okay, how about as part of this, we'll pull some money to build a road that goes between the two, like this. So build a road that goes from there to there. All right, we'll go halves on that, and we'll contribute staff to go and build it. Both of us, staff going together. Sure. Okay. Well, what about if we have it seems a bit silly to do essentially the same accounting functions. So how about we just get our accounting staff, and we just send them over to you guys over here, and we'll just have one team of people doing the accounts for both. Can you see where I'm going with this? And then the closer, this hole's a little bit blocked. How about we send all of our staff, and we'll do the night shift in your hole, and you do the day shift, and then we'll do the same thing over there when that one's finished, and then we'll collect that, and we'll just split this amount 50-50 instead of whatever we find. Can you see that this factual situation has gone from being one where things are arm's length to being one where you've got a lot more scope for stuffing up the other side? That's what fiduciary duties are about. It's about the ability to do bad things to other people. And we don't want that. We want to place very high duties on people to stop. The general law does do this. And so what started out looking like a joint venture, and there would have been a document that says this is definitely a JV, right? And that was the intention of both parties, right? And ultimately, if this whole thing went through and they're all happy with this arrangement, everyone walks away happy, there's no problems. However, what happens in life? This whole collapses, all right? And a whole bunch of Rio Tinto staff are killed. Who's going to be held liable for that? All right, and then you're trying to look, well, was it these guys who did the safety, the health and safety thing wrong? Was it these accounting staff? Was there a defect in the road? Or was it caused by one side or the other? In situations where things go wrong, and one side has done something bad in regards to the other side, if it was a joint venture, it's governed by the agreement, and that may just be the lost falls where it lies. Who knows? Whatever. Rio Tinto and BHP have got expensive lawyers. If there's a fiduciary duty, though, because basically it's been deemed at law to be a partnership, even though the parties didn't want it to be a partnership originally, when something's gone wrong, you can examine the facts to determine whether one, in fact, actually exists. So really, that's the sort of the final thing to take away in terms of partnership and partnership law, because you can have situations where what starts looking like a joint venture actually is a partnership, because of that ability to influence or affect each other.